Okay. Today, what we're going to talk about is potential solutions for unemployment, and this is quite a complex area. There've been an awfully large number of different schemes tried by large numbers of governments across the world, and of course, it's very difficult to assess which ones of them have worked. And starting at any given moment in time, what's going to be most appropriate is going to depend on what the cause of unemployment actually is. So it can be quite hard to structure this. So what I'm going to do is I'm going to base it around the different types of unemployment. But as we said before, when we looked at the causes of unemployment, it's not the case that anybody's walking around with a sticker on their head saying I am frictionally unemployed. So what we'll have to try and do is talk about what policies might be appropriate to a particular type of unemployment, and then branch out and say how that might affect other types. Anyway, what we'll try and do is get a bit of structure involved here, and then we can see where we go. I'll just have to hope that this isn't too oversimplified. But anyway, we'll see. Okay, so we categorised the causes of unemployment into two broad types. On the one hand, we had demand deficient types. So problems with the demand side. In other words, firms, there simply weren't jobs available. Firms weren't hiring. On the other hand, we had supply side type causes where there were problems with the structure of the labour market, something to do with those who are making themselves available to work or not. So we take demand side first. We've said this comes under a whole variety of different names: cyclical, Keynesian, demand deficient, and so on. So a Keynesian would say the answer is very simple. If we have a lack of demand, then what you do is, guess what? Create demand. And broadly speaking, we can say that there are two main ways in which you can do that. On the one hand, there's fiscal policy. We could use tax and government spending. On the other hand, there's monetary policy. We could use interest rates and quantitative easing. So if we start with fiscal policy, splits into two: government spending increases or tax decreases. And what we looked at in the lessons was a University of Massachusetts study in the United States, and they looked at the impact of $1 billion of either government spending or tax cuts in different areas, and tried to assess the impact of that on job creation. And what the University of Massachusetts study found was that the most effective way of spending $1 billion was to build things. If you went and built infrastructure, then that had a big impact on job creation, and that's because it was each $1 billion created about 20,000 jobs, and that's because obviously infrastructure building is quite labour intensive. Although there's capital involved, obviously you need quite a lot of workers, and also it has quite a lot of multiplier effects to labour intensive industries as well. Yes, if you're building roads, you need concrete, you need steel girders and all that type of stuff. So what you're doing is you're creating quite a lot of manufacturing multiplier effects that are going to spread out from your initial investment. And as usual, people that you get employed have high marginal propensities to consume because they didn't previously have income, and again that will make the multiplier effects big. So one thing we can do then is we can spend money on infrastructure, and of course, if you spend that money in the right area, you build the right type of infrastructure, then that may also have a favourable impact on other types of unemployment. So it might also help to reduce regional issues. Yes, if you can build better infrastructure in the UK, either between the north and the south, or even recent proposals within the north, to link the big northern cities, then that might well help to increase labour mobility. So it's not just that we're digging holes and filling them in again. Yeah, we're targeting money at appropriate infrastructure, which creates jobs in the short term as that infrastructure is built, and then may also help to create jobs in the longer term by improving regional mobility of labour. Other things that you could spend money on, the study suggested spending money on education, which is also quite labour intensive. To provide education, you need quite a lot of teachers. And the suggestion there was that, according again to this University of Massachusetts study, was that I think each $1 billion there was going to create about 17,500 jobs in education. And and then again, assuming that those jobs are appropriate and sensible, then there are going to be spin-off benefits from improving the education, assuming that it does improve the educational attainment of students. There are going to be spin-off benefits in the long term by providing young individuals with school leavers with better skills, hence making it more likely that they're going to find jobs and therefore maybe reducing youth unemployment. They also looked at the impact on defence spending. So suppose we spend $1 billion on defence, that was far less effective. It was fewer than 10,000, I think. So it was 8,500 jobs per $1 billion that you got by spending on defence, because defence, especially in the States, it involves lots of technology, which again might not necessarily be a bad thing, but it doesn't necessarily create large numbers of jobs. Lots of that. An increase in spending isn't going to be recruiting new soldiers in the States. It's going to be research and development and so on, which may have again benefits elsewhere in the economy, but it's not necessarily going to create jobs. They also looked at the impact of just paying out increased unemployment benefits, and they found that this was actually quite effective. It created something like about 19,000 jobs for each $1 billion that was spent on increasing benefits, because obviously benefit claimants have a very high marginal propensity to consume. You give money to a benefits claimant, then they're going to spend it. So therefore we're going to get lots of demand in the economy, which then going to create multiplier effect, create jobs and so on. Which is fine, but there's an obvious problem, which is that if you pay benefit claimants more money, there is a risk that that they will then be more likely to continue to claim benefits, that they may be slower to find jobs. So it could increase the level of voluntary unemployment, and it might also make those who are between jobs slower. We talked about when we looked at the causes of unemployment, we talked about the motivation to find a job. And what we might find is that it makes people slower to go out and acquire one. So all of the usual criticisms that we've come up with of rising government spending, will also apply here. So we talked about the risk that debt will get bigger. We talked about and hence creating crowding out effects and so on. We talked about the dangers of white elephants and so on, and all of those things will still remain true here as well. On the other hand, you could cut taxes, and the same study, different one. Sorry. Again, it's an American study by the Congressional Budget Office, the CBO. They looked at they looked using similar methodology. They looked at the impact of tax cuts, and again, all the way this has been reported is in terms of what would $1 billion of tax cuts do. In the States, one of the most popular ways to try and stimulate demand has been to cut income tax. But the trouble with cutting income tax, the study says this is the least effective way of cutting taxes. Is if you cut income tax, then by definition you're cutting the taxes of those who have incomes. The clue's in the name. So hence you're cutting the tax of people who already have jobs. And their marginal propensity to consume is going to tend to be much lower. You cut my income tax, I have more money, I'm just going to stick it in a pension. So they found that less than half of the money that was cut in the form of income tax actually got spent. So therefore, it created $1 billion of income tax cuts, created about 10,500 jobs. And that's including the fact that it might also create incentives to work. So by cutting income tax, it might reduce voluntary unemployment. It might make people more prepared to go into the labour force. But nevertheless, it wasn't particularly effective. Other possibilities would be to cut VAT. So we know that in the early part of the credit crunch, that was what the Labour Party did back then. They cut VAT from 17.5% to 15%. It's difficult to know how much effect that's really going to have had. 2.5% in the end isn't a huge amount of money. So as we were saying, 2.5% on a 500 quid flat screen telly or something, is about £12.50. And it's not clear how much impact that's going to have in terms of motivation to spend and so on. Another one that was looked at by the CBO study was what are called payroll taxes. In the UK, these are called employers' national insurance contributions, and it's the tax that you pay to employ somebody. So Dover Brooks pays me probably somewhere around £50,000 a year, but on top of that, they have to pay tax to the government, as well as paying me £50,000 on which I pay tax. Dover Brooks also has to pay a tax on top of that 50,000 quid. And so obviously that's that eats into Dover Brooks' profits, meaning they have less money for other stuff, and B, it's just a disincentive to take on new workers. And what the CBO found was that cutting payroll taxes, cutting these taxes on the cost of employing people, was one of the most effective ways that you could create jobs using tax cuts. And when we're looking at some of the proposals that have been put forward, there are major political parties who are suggesting that a good way of creating jobs might well be to, particularly for small firms, to cut or give them a complete break from paying national insurance contributions, these payroll taxes on new workers. So that seems to work. I mean, the danger with this type of scheme is that you don't know what jobs would have been created anyway. So if we kind of say you can have, you don't have to pay any tax on new jobs that you create, well, a lot of firms would have created those jobs anyway. So all you're doing is just giving them free money, and that's the danger with lots of employment subsidies type schemes, and we'll come back to those later. Other possible taxes you could cut would be a cut in corporation tax, a cut in the tax on company profits, and that's what the Conservatives have been doing over the last, and Labour over the last, 10, 15 years. Gradually corporation tax coming down from 30% to ultimately is going to hit 20%. One of the problems in terms of is this going to create lots of jobs is, well, are firms going to invest that profit? A lot of the big firms don't pay much corporation tax in the UK, so they pay it all in Luxembourg. So people like Amazon and Microsoft, they arrange their tax affairs so that they pay corporation tax where there is no corporation tax. And in any case, during recession, they're not really making any profit anyway. So cutting the tax they pay on their profits, like, well, cheers. I'm not making any profit anyway, so what? And likewise, those all of those tax cuts, run into the problems that we talked about elsewhere. That I won't go into again, because I can already see now that I'm only going to be able to talk about demand side and employment solutions for that in this particular clip. I'll do supply side at a later point. So on the one hand, we could use fiscal policy. On the other hand, we could use monetary policy. So we know that during the early days of the credit crunch, the Bank of England and central banks across the world, they slashed interest rates. In the UK, they fell from 5.75% down to 0.5%, the Bank of England's base rate, in no time at all. And the theory was that this was going to help to create, this was going to reduce people's mortgage payments, so they'd have more spare income, so they wouldn't need to cut back quite so much. It might help to support investment, although it's pretty doubtful. Cuts in interest rates, as we said before, may also weaken the exchange rate, which may or may not be a good thing. But in theory, it might help to boost export demand. Yeah. So in principle, when we did slash interest rates, is that going to create jobs? It's more likely to prevent unemployment from rising. In other words, the point at which you're slashing interest rates normally the wheels have come off already. So really, what you're doing is probably is trying to keep businesses alive, trying to support them. There are a variety of problems in the UK if we look at what the situation would be going forward. So we're probably in what's sometimes called the liquidity trap. interest rates are already 0.5%, so the scope for cutting them isn't really much more. And as we know, I mean, in any case, and the UK economy is now recovering reasonably well. The output gap isn't particularly strong, sorry, big. And the output gap isn't particularly big anymore. We said when we looked at the causes of unemployment that from its peak of 2.5 million, unemployment's come down to under 2 million. So, I mean, in general terms at the moment, the extent to which cyclical unemployment is the problem is open to question. There's probably is going to solve itself now. Now, whether that doesn't mean that 5 years ago it mightn't have been a good idea, but pushing demand up at the moment, I think, carries the risk of pushing us below the Nehru. In other words, the output gap, the gap between actual unemployment and our kind of capacity in a kind of supply side sense, that gap's quite small now. So therefore, there is a risk that if you engage in much more stimulus, all that's going to happen is you're going to push unemployment below the Nehru, and you're going to start getting inflationary pressure. But anyway, separate from the UK at the moment, in the abstract, cutting interest rates can work. It can have an impact, and certainly, certainly leaving them high is going to be a rotten idea. Although, as we said before, if you're not a Keynesian, you might argue that providing cheap money, especially QE, which I'll talk about in a minute, may just lead to asset bubbles in the future. And this is the big, there's a big Hayekian argument, that if you cut interest rates, and you push money into the system, all that's going to happen is that you're going to get malinvestment, money's going to flood into property, you're going to have a housing price bubble which will pop, and then you'll be back where you started again with high levels of unemployment. The other element of monetary policy that's been tried recently is QE, quantitative easing, and this is much misunderstood. It's an asset purchase scheme. So basically, the Bank of England creates money. Which it can do. We think of money being printed and kind of coming off the printing press, with kind of lots of notes spinning out. But of course, in reality, they just kind of press zero on a computer and lots of zeros, and money is created. And what they've done with that is they have bought government bonds. So they've pushed money into buying UK government bonds, and this has a number of effects. Firstly, the price of those bonds goes up. And for a variety of reasons, this will also spill over and have an effect on other assets as well. So the holders of government bonds and other financial assets, they become wealthier. And we said last year that rising asset value, it increases confidence, it increases your wealth, and it makes it more likely that you're going to spend. So again, hence aggregate demand might well be stimulated. Secondly, obviously, if the Bank of England buys bonds from somebody, they were previously putting that money in an investment. If we now give them cash, they're probably not just going to go out and blow it on a new car. What they're going to want to do is they're going to want to save it. So therefore, what's going to happen is a lot of this additional money, and in total, it's been about £375 billion that the Bank of England has invested into this scheme, has put into the scheme. A lot of that money is going to find its way into the banking system. And what's that going to do is going to mean that there's more money available to lend, is going to put downward pressure on interest rates because firms are going to want to lend it. So banks are going to want to lend this money. How much effect this has had, again, is difficult to measure in the sense that we know that unemployment stayed high. I think the question you've got to ask yourself is what would have happened had we not put £375 billion worth of funds into the system. Given that putting £375 billion in doesn't seem to have done a whole heap, it's mainly propped up banks' balance sheets. It's replaced the money that temporarily at least that was lost during the housing crash. But had we not done that, I think we could be looking at a much worse situation. So on the one hand, we can use fiscal policy. We can increase government spending. We can cut taxes. On the other hand, we can use monetary policy. We can cut interest rates. We can engage in QE. The criticisms of monetary policy seem to be largely that that the banking system isn't working very well, and that therefore monetary policy, especially at the present time, may be less effective. If you're a neoclassical economist, remember you're not going to have any of this. If you're a neoclassical economist, you're going to be saying the lack of demand isn't the problem. If the labour market and product markets work properly, then unemployment can fix itself. So So if we can, there's no point in increasing aggregate demand, because all that's going to happen is you're going to create new bubbles, you're going to create problems, you're going to create distortions within the market. And therefore, what you need to be doing instead is to increase labour and product market flexibility. What we want to do is we want to remove restrictions to wages falling, like the national minimum wage, maybe reduce trade union power, increase competition between firms, forcing them to be efficient, and that way, and also by reducing the size of government, by reducing government spending, that will allow tax cuts, which will free up resources to be used by the private sector. What that's going to do, therefore, according to neoclassical economists, is it's going to create growth. By making the government smaller, this creates more resources, it creates the opportunities for private sector firms to use those resources efficiently, creating growth, and growth will create jobs. So they would argue that the emphasis shouldn't be demand, that demand is kind of a symptom, not a cause. A lack of demand, it happens from time to time. What you need to do is to make sure the economy can recover from that shock. So, if we have a lot of cyclical unemployment, a practical solution would be in the short term to raise demand, but you might prefer not to do that because it creates distortions. But as far as we're concerned, we can use government spending and tax cuts, increasing government spending and tax cuts to stimulate demand within the economy. Part of your job, if you're asked this in an exam, will therefore be to evaluate that. To think about the different types of government spending, what might be more effective, what might be less effective, and the same with tax cuts. This has gone on now for over 20 minutes, so sorry about that. And I haven't come on to supply side unemployment either, which I'll do in a separate video. It's not going to be now, I don't think, so I'm going to go and wake my daughter up. But I'll try and do it early next week, and we'll talk about the other types of unemployment and some of the schemes that have been tried. So that's it for now. Sorry it's gone on so long.